Now, the U.S. Federal Reserve kept their rates unchanged as well, but Chairman Powell says Americans should expect at least one more rate hike before the year 2024. Benji Heyer has more info from Washington, D.C.
This was no real surprise. We sensed this was coming. The Federal Reserve for the past year and a half has been aggressively trying to tackle inflation, hiking interest rates to a 22-year high. It's a strategy that the Fed says has worked, and now it's slightly pushing on the brakes, deciding not to raise rates again, keeping it within this 5.25 to 5.5% range. It's a decision that Chair Jerome Powell determined is, as of now, appropriate as part of the efforts to bring down inflation. In a press conference on Wednesday, he told reporters that he's aware of the hardship that high prices are causing, and inflation is amongst the central bank's priorities going forward. Here's the thing, whilst there was no raise anticipated this time round, there remains considerable uncertainty over what steps the bank will take next, especially given that inflation, despite being around the 3% mark, which is far lower than it was before, remains above the 2% target. And the key question that's asked of Jerome Powell is essentially what is going to happen next. He says that he's trying to keep his options open. He has hinted at possible further rises by the end of 2023 before any potential cuts in 2024, and that these rates may remain higher for longer. And the challenge, I think, is that this monetary battle won't necessarily be won overnight. As I mentioned, inflation currently hovering above 3%. It's not likely, Mr. Powell says, to get to that 2% target until the year 2026. Benji Heyer, CGTN, Washington.
For reaction to that, John Terrett on the floor of the exchange.
After the closing bell on the Wednesday session on Wall Street, FedEx, the worldwide logistics company, gave us their earnings, and they were mixed. They beat with the earnings per share, they missed with the revenue, and their guidance was mixed, though the shares were up by 3% in the immediate aftermath of the news being published. On the main markets, well, proceed carefully. Those are the words from the mouth of Jerome Powell, the chairman of the central bank, the Federal Reserve, after he paused again in his interest rate hiking campaign, but hawkishly warned of potentially another interest rate hike before year's end. The markets fell off on this news. The Dow was down 1/5%. The Nasdaq hammered, down 1.5%. The S&P 500 down by almost 1% to stand at 44.02. Bitcoin was down just under 1%. Ethereum down just over 1%. And on Thursday, we get the weekly jobless numbers, the number of people signing up for first-time unemployment benefit at the state level as of last Saturday. And at the UN, there's a major biodiversity conference coming up, which is important for business, of course. And Han Chung, who is the Vice President of China, will deliver his country's address to the UN General Assembly in the afternoon session on Thursday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on this big decision in on the U.S. economy, Ted Rossman, of course, joins us back, senior industry analyst, bankrate.com and creditcards.com. Ted, good to see you. Let me start with this. The Federal Reserve actually did what I actually thought they were going to do, and no one should have been surprised by what they said. Why were they surprised?
I think the most surprising thing was probably in that summary of economic projections, where this higher for longer attitude is really coming true. Most Fed participants expect one more quarter point hike this year. And then the median projection for next year is only a half a point lower. So maybe 2 quarter point cuts, let's say. At the last summary of economic projections, the projection was more like 4 quarter point cuts next year. So this is one of the reasons why stocks closed at session lows today.
I want to play you a clip of what the chairman said earlier regarding the economy. Here, just listen to this.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Ted, am I right to translate that into the inflation is the main priority? I get that. But it's also more important than pretty much everything else, and he's willing to have below growth, I guess below trend growth, basically to the expense of the economy.
Yeah, it was interesting. Jerome Powell was even asked directly during the press conference today about GDP and how that factors into the Fed's decisions. And he talked about the Fed's dual mandate, which is basically full employment and stable prices. And he said that GDP is not really part of their direct mandate. Now, of course, they want strong economic growth, but he actually talked about how GDP factors in mostly because if it's too strong and if it's making it too difficult to bring down inflation, then the Fed might need to hit the brakes a little bit harder. So I think some people took today's words as kind of cold water. I think they were hoping for maybe a little more wiggle room on, okay, we're done hiking and maybe soon we're going to start cutting. We didn't hear any of that today. We definitely heard a pretty strict towing the line on this
Right.
inflation
Now,
fight.
he did say, though, we had 3 months of good news on the inflation front, right? Whether you take the headline number, or you take the core number, regardless, I think we can agree that it's positive. But I do worry about August because, while the core number might not necessarily go up, I don't have to tell you this, gas prices have significantly spiked up. Food might be in place, but the problem with gas prices is that bleeds into everything that we do, whether you're ordering something to deliver at your house, or you're driving your kids to school, or you're just going to work. We all feel the impact of gas prices, whether they're at $5, $6, or $7 a gallon like they are in California.
Higher gas prices are definitely a headwind to this whole inflation fight. Of course, people say the stock market always climbs this wall of worry. I mean, there's always something to fret about, right? But Chairman Powell was asked directly about some of these risks today, things including Russia's war in Ukraine, higher gas prices, a possible government shutdown here in the U.S. as soon as the end of next week, the resumption of student loan payments. There's all these things kind of swirling out there that could pinch the economy and consumers. And it certainly bears watching. I think, the Fed continues to stress data dependency as well. And provided there's no government shutdown, they'll have fresh economic data to digest before the next meeting. That was another thing the chairman referenced, though, which is that if the government is shut down, the cadence of some of these reports, like the monthly jobs report and others, could be disrupted.
Right, which let's be honest, it should not be a very high probability of that happening, but I guess we have to talk about it. The other thing, too, is regarding the data, the jobs unemployment rate remains low, the job market remains tight, and he didn't really talk a lot, or I didn't hear the part where they talked about job, wages, and inflation. The wages have gone up more than I think some people had expected, and not to say that's the cause for inflation, but that certainly isn't going to help.
That's true, but I think the Fed is comfortable with where the job market is right now. We've definitely seen some loosening of the job market, which is really what the Fed needs. But fitting into this soft landing hypothesis, I feel like we've gotten further into this with a strong job market. I think people feared that job losses could be worse. I think right now the job market is stable, and I think that plus some other better than expected economic data is emboldening the Fed a little bit to continue on this higher for longer feeling to hopefully fully stamp out inflation.
And if not to confuse our viewers, but the dot plot, in other words, what people predict might happen into the future, I think that's a whole nother conversation itself, but I'll just summarize it by the thoughts of perhaps higher rates, which means one more rate hike maybe in November, and then keeping that rate higher for longer throughout the first quarter or two of next year. I mean, is that the assumption as we as investors should now make?
Yes, and that has really important ripple effects for the economy and for consumers. I mean, look at mortgage rates, which are at their highest point in about a quarter century. That's not going to change in a big way anytime soon. Credit card rates are at their highest point on record. Auto loan rates are at their highest in 15 years. I think we're really going to have to continue to adjust to this new normal. I think the housing market is probably especially bummed by today's news because this whole higher for longer thing, I mean, I think people were starting to feel like, okay, maybe we're starting to see the light at the end of the tunnel with the housing market starting to improve. But, the longer mortgage rates stay above 7%, let's remember that 80% of current homeowners have rates below 5%.
Right.
And they're not really willing to trade to a higher rate. So it's going to be a while, I think, before rates fall in a meaningful way that could loosen up some of this inventory.
Yeah, really, really good points. Ted, good to see you, my friend. Let's keep an eye on this. Thank you.